I'm here with founder of hotspotting.com.au, Terry Ryder, and we're asking questions about successful investors today. So, Terry, when did you buy your first property and what age were you?
I was in my 20s. It was in the early 1980s. I got very tired of the problems of renting, so I decided to buy my first home. It cost me $25,000.
Wow.
It was in a outer south western suburb of the Greater Brisbane area, a suburb called Bundamba. Extraordinary today to think you could buy a 3-bedroom house on a 1,000 square metre block of land for $25,000. About 2 years later, I sold it for $41,000. Thought I was a genius because in percentage terms, I'd made quite a lot of capital gain, bought something better, a little bit closer to the action in Brisbane.
Yeah, right. So you answered my next question if you still got it, but you sold it. So what would it be worth today?
Probably around about $500,000. It's still a very modest home. Sometimes I've driven past it. I don't think anyone's spent any money on it in the intervening period, but the market value would probably be around $500,000. So it's increased in value tenfold. So it would be lovely to still have it.
Yeah. So what is your basic philosophy underpinning your real estate investments now?
Look, I've always liked to buy real estate in what I call bite-sized chunks. You know, if I have $1 million to spend, I'm not going to spend it on $1 million property. I want to leverage that into 2 or 3 properties. I like to buy in affordable locations with good rental yields. And I think there's a bit of a myth around that you get inferior growth in those sorts of places. I haven't found that, and our research would certainly contradict that. So it's very much buying affordable property with geographical diversity. I think that's incredibly important. I'm always surprised how many people I talk to who own 3 or 4 or 5 properties and they're all in the same town or the same city or the same state, and I think that's a mistake.
And do you believe that people should buy and sell property, or do you believe they should buy and hold property?
I think the way to go for most people is accumulating a portfolio, buying good real estate and keeping it and building on that. I think if you buy and sell, probably try to trade your way to success. You're losing a lot of your gains in fees and taxes, capital gains tax, agents' fees, etc. So for me, the way forward for most people, I think everyone's different and have a different approach, but I think the best way to go is to accumulate a portfolio.
Yeah, terrific. Many investors are reluctant to spend money on advice and information. How important is it to invest in advice and information before buying property?
Yeah, I'm always stunned at how people are willing to spend the big money on the real estate, but not the relatively small amounts on getting that purchase correct, to making sure they're spending the $500,000 wisely. So a lot of people try to penny pinch their way to success with property investment, unwilling to spend money on advice and information. And I think it's the worst kind of false economy. I think that's why so many people get bad results, why so few people end up with a portfolio, get beyond 1 or 2 properties, because they haven't gone about that first and second one the right way. And their biggest problem, I think, is the unwillingness to spend money on advice.
The Australian Bureau of Statistics says that less than 1% of investors have 5 properties or more. Why do you believe that most people have only got 1?
Yeah, well, I think for all the aforementioned reasons, they're not willing to invest in good information and good advice, so they stumble into real estate. I think a lot of Australians like the idea of owning real estate, and they begin their journey by going online looking for properties to sell. Now we have an 8-step process, the Ryder investment system, and looking for properties to buy is step 7. But most people neglect steps 1 through to 6, which is so important. Understanding your borrowing capacity, your risk profile, getting good advice, getting the right entities in place. All of that, most people neglect that. They go straight to the exciting bit of wanting to buy real estate, and they often make fundamental errors, and that first big mistake prevents them from buying a second, a third and a fourth property.
Now, you've been a big advocate for building your team before you build your portfolio, and I suppose that comes into that as well, doesn't it?
Yeah, I think that's so important, and we tell people that all the time. Those earlier steps before you start looking for property for sale include building a team, finding a good accountant so that you talk about the right entity to buy in. And so many people find out too late that they've bought in the wrong entity, they've bought in their own name, or joint names with a partner or a trust or a company, which is the wrong structure for them. So that's really important, getting good advice from a mortgage broker. So many people seem to stick with the same bank. The mortgage brokers call those people who pay a loyalty tax, and it is a tax because the loyalty is not reciprocated by the big lenders. So it's very important to have a mortgage broker who can find you the best deal, including when you actually have a mortgage, but your interest rate's gone up, you can refinance sometimes and get a better deal if you've got a good mortgage broker on your team. The biggest way in which banks don't show loyalty to people is that they always offer their best deals to new customers. So if they've decided to have a cut price interest rate deal or cashback, that's always for new customers. They don't extend that to their loyal existing customers. That's why so many people refinance and move, because that's when you get those special offers. I don't understand why the banks think that way, because they're losing customers all the time through not showing loyalty to the people who most deserve it.
We recently just made it into a level with NAB called Premier Banking, where you get a personal banker. And since we've made it into that level of banking, they can't do anything for us. So we're literally having to move banks from getting into the top tier because they can't offer us anything else, and they won't even offer us a better rate than I can get at another lender.
So that special status that you've achieved actually gives you nothing.
It's pointless.
Yeah, it's just a piece of marketing, isn't it?
It is.
Yeah. Having mentors, being willing to pay for mentoring is really good common sense. It's false economy not to do it. And being willing to pay for good information. So many investors want to sort of grab anything that's free out there in media perhaps, and quite often it's misinformation. So it's false economy being unwilling to actually pay for good information.
And for a lot of people, it's fear that sort of stops people getting into the market in the first time to buy that first investment property. But how important is it that you get the first one right?
Well, it's absolutely crucial, and it's important that people get the finance right with the first one, but it's even more important that the choice of location, the choice of property, and the price that they pay is right. You can only achieve that as a novice investor if you've got good advice on board to make sure that you're buying that first one right.
Yeah. Now, you've been in the real estate industry for 4 decades now, so I'm keen to know, what would the 25-year-old version of Terry Ryder tell himself today?
He would say to Terry, never ever sell.
Yeah.
Now, I know that's a bit of a blanket statement. That there are instances where it is wise for people to sell something they have in a portfolio, but as a fundamental philosophy, if you own good real estate, it's great to keep it. And when I look back on that very first one that I bought for $25,000, it would now be worth $500,000. But perhaps more particularly my second one, which was a humble house but sitting on a hill with views of the Brisbane River, which I bought for $50,000, and today the land alone will be worth over $1 million.
Wow!
I dearly wish I still owned that property, and others that I've bought along the way. Because in my early real estate career, I was buying and selling. I thought the way to go forward was to sell what I had for a profit, and buy something better, and to improve that way. So yeah, never ever sell. Accumulate good property and keep it. It's very much the philosophy of Warren Buffett, one of the world's most wealthy people, one of the world's most successful share market investors. But he has that philosophy for his share market investing. He buys good assets and keeps them. He says, I don't care if they close the market for 5 years, I didn't intend to sell anyway.
It's funny, we often talk about investors when we're talking about growing portfolios and using real estate to create wealth, but even homeowners, it seems that every time they do sell their house, they go into another property that they spend up, don't they? They never come and buy something for half the price that they've just sold the last one for, so they're always sort of on that wheel.
Yeah, that's right. Until you get to a certain age when you're looking to downsize, and downsizing in the size of the property, the size of the land, and the size of the financial commitment, perhaps.
Now, are there any mistakes that you made throughout your journey that you would urge other investors not to make?
Well, I think it's that fundamental one of having bought what turns out to be really good real estate, very well located real estate for what today would appear to be a pittance, and not keeping it. But that's the big mistake. I think I would urge people not to repeat that one.
Yeah. What do you think the biggest myths and misconceptions that people have around real estate investment are?
Look, there are so many of them, and many of them are media-driven, but a lot of them relate to the value of location. For example, that one of the big myths is that you've got to be close to the CBD to get the best capital growth, or you've got to buy in the biggest cities to get the best capital growth, that the outer ring areas have inferior growth, and the research contradicts that. And that's good news for most investors, because most investors starting out in particular can't afford to buy in those expensive inner city areas or the so-called prime suburbs, but they can maybe afford to buy in an outer ring suburb or in a regional area. But the good news is that if they choose their locations well, they're going to get some of the best capital growth that's on offer, as well as getting better rental returns, because the cheaper properties do tend to have better prospects for being cash flow positive, or at least neutral.
I asked you a question about giving yourself advice at the age of 25. I'm going to ask you again, if you were 25 today, would you choose to buy your own owner-occupier home, or would you choose to be a rentvestor?
Look, it very much depends about where my life was situated. You know, if I was growing up in, say, Melbourne or Sydney, and I had family there, my career was there, then I would be a rentvestor, certainly. I wouldn't let the fact that I couldn't afford to buy my first home where I wanted to live in those big cities stop me from becoming a property buyer. But otherwise, I would urge people to buy their home in an affordable area if they can. I've had a lot of conversations with young investors who realise that with modern technology, they can be pretty much anywhere to do their job. And if they're willing to go elsewhere, to go interstate, to go regional, they can move to a more affordable area with a different lifestyle, and buy affordably their first home and get on the home ownership ladder that way.